Welcome to this lecture on portfolio theory, a fundamental concept in modern investing designed to help you achieve the best balance between risk and reward. At its core, portfolio theory answers a crucial question. How should an investor mix different investments to achieve the best possible balance between risk and reward? The central idea is simple. Do not put all your eggs in one basket. This concept, known as diversification, is key to reducing overall investment risk. In finance, return is the reward you expect from an investment, while risk is the uncertainty of that reward, not just the potential for loss. For instance, a savings account offers predictable returns with low risk, whereas stocks move unpredictably, carrying higher risk. The magic of diversification truly shines when investments do not move together, creating a stabilizing effect on your portfolio. If two investments rise and fall together, they offer little diversification. However, if one rises while the other falls, they balance each other out. This stabilization effect is the essence of diversification, allowing you to avoid significant losses from any single investment. There are two main types of risk, unsystematic and systematic. Unsystematic risk is company-specific and can be diversified away. Examples include a CEO scandal, product failure, or supply chain issues, which can be mitigated by spreading your investments. Systematic risk, on the other hand, is market-wide and cannot be diversified away, affecting all investments. This includes factors like inflation, recessions, and interest rate changes, which impact the entire market. A classic example of diversification is combining stocks and bonds, which often move in opposite directions. When markets fall, investors flee to bonds, causing bond prices to rise, while during market rallies, bonds may offer modest returns. Another example is balancing airline stocks with oil companies. When oil prices rise, airlines suffer, but oil companies profit. Conversely, when oil prices fall, airlines thrive, while oil companies may struggle, creating a natural hedge within your portfolio. International diversification also plays a vital role. A U.S. investor holding Japanese or European stocks benefits when foreign markets perform well, even if U.S. markets stagnate. An efficient portfolio achieves the highest return for a given level of risk, or the lowest risk for a given level of return. The efficient frontier represents the smartest possible mix of investments, optimizing your portfolio's performance. Adding a risk-free asset, such as U.S. Treasury bills, significantly enhances portfolio stability and growth potential. This combination leads to simpler portfolios, lower overall risk, and more predictable outcomes, especially during recessions. For example, an 80% S&P 500 index fund combined with 20% U.S. Treasury bills offers much lower downside risk than pure stocks. This balanced approach provides surprisingly strong long-term returns and stability, even during economic downturns. Investor portfolios vary based on risk tolerance. A conservative investor might hold 20% stocks, 60% bonds, and 20% cash equivalents. A moderate investor might opt for 50% stocks, 40% bonds, and 10% cash, balancing growth with stability. An aggressive investor seeking higher returns might allocate 80% to stocks and 20% to bonds. These allocations are based on personal risk tolerance, not on chasing so-called superstar stocks. Common mistakes investors make include believing more stocks automatically means better diversification or chasing hot stocks based on hype. Ignoring correlation between investments and owning many stocks in the same industry are also frequent errors. For example, buying Tesla, Toyota, Ford, and GM might seem diversified, but all are in the highly correlated automotive industry. Other mistakes include holding cash for long periods, which carries inflation risk, and failing to rebalance the portfolio regularly. Understanding these principles of portfolio theory is crucial for making informed investment decisions and building a resilient financial future. Thank you for watching this video on portfolio theory. We hope this information helps you make smarter, informed decisions.